Is it better to be optimistic, pessimistic, or realistic about your investments? Believe it or not, that is not a philosophical question. It is a fundamental determinant of your experience in building wealth. This is all part of setting your expectations. If you're anything like me, then you keep your expectations low because that significantly drops the chances of being disappointed. But that mostly related to my approach after examinations in school. Is this the right approach in the market though? That's a question. Because if you're not optimistic about the India growth story, then you may not make the best of it. Irrespective of your mental state or expectations though, markets have phases that are not the easiest to predict, but you can still make the best of it. There's an accumulation phase, which could also coincide with a drawdown phase, and there's a bull phase. Where do we stand right now, and what should your approach be? This is Moneywise on NDTV Profit, and my guest today is Vijai Mantri. Vijay, thanks so much for taking the time.
Thank you very much.
What did you think about my my practice of keeping my expectations low?
I think it's a fantastic idea in any walk of life. To stay happy in any walk of life, keep expectation low is not the bad thing. Because the outcome is not in your hand. What is in your hand is how do you prepare yourself.
But the opposite is also true, and I've heard this said, because when I've expressed this in the past, people have said, Alex, you're too pessimistic about the India growth story, about the money that can be made out there. And if you keep your expectations so low, you may not expose yourself to things that can make you a lot of money.
So a lot of people believe that high risk means high return. It is not necessary. Beyond the point, incremental higher risk does not result into incremental higher return. And as far as investing is concerned, it's just like your food habits. What works for you, what works for you. If some people can digest chili paneer, good luck to them. I can't digest, so I'll not have it. So money is too personal a subject to be guided by what we see everywhere else. So one need to be very clear what kind of spouses should have. It is not on public opinion. It is what the alignment or kind of combination or kind of compatibility you have with the people. So same with investing. Many people don't understand this logic that finance is too personal a matter, and a lot of behavior, the background of the people comes into picture. So it is very important to understand where you stand and then start getting realistic about where you want to go. So if you look at, before you set expectation, you need to understand how various investment or asset category perform, why they perform, what are the drawdowns, what are the accumulation, whatever you talk. So you just look at debt. Debt will give you return which are closer to inflation number.
Right.
This is the data for India for last 25, 30 years. Inflation has been around 7% and most debt deliver you around 7%. So that is the expectation.
And when you're saying debt, just to clarify, you're talking about government debt, you're talking about whatever the government of India has issued.
So where we invest, FDs and corporate bond and all of them. And debt fund deliver a little better than the bank. By the bank, in all debt product, bank deliver the least investment performance. Why? Because bank has to plan for CRR, SLR, priority sector lending, and only part is available to lend.
Yeah.
So a simple metrics to look at is look at any time period's bank FD rate and look at the T-bill or CD of the same time period of the same bank.
Yeah.
The T-bill is definitely issued by RBI. They're always 1.5%
The certificate
higher.
of deposit.
So always 50 basis to 1% higher in normal course of the business.
Sure.
The second we come to equity and real estate.
Yeah.
Equity will deliver you, in India it is delivered over last 30 years. Return, I'm talking about Nifty 50 and Sensex 30, a number closer to GDP growth. Yeah. GDP growth plus inflation, nominal GDP growth, that is a kind of number. BSE Sensex 30 and Nifty 50 has delivered. But broader market has delivered much better investment performance. And if you look at real estate also does the same thing, GDP plus inflation. But real estate is too geographic specific. So that is the one part. Second, whenever we talk about expectation and kind of thing, you're setting ourselves for the absolute failure in investment journey. Because in last episode, we discussed about the gold. And people made money in gold, not by having view, not by having expectation. They made money in gold.
Simply by buying it every year.
Buying and keeping it forever kind of thing. People made money where investing period has been very, very high. Similarly, ask anybody if they had a 20, 30-year-old equity portfolio, particularly managed asset, how it has done. But the problem is that we are a social animal. We get influenced by what we hear, what our friends are talking. Trump is doing this, economy is no. So these headlines keep, changing every day. But your portfolio should not become victim of that. So rather than setting expectation, whatever it is, I think it's very important to understand how the various asset class perform, what are the challenges in these asset classes, and how do you protect yourself so you don't fall to these kind of negativities when you construct your portfolio and investment journey remain very stable.
Yeah, when I said expectations, the thesis, of course, is that you got to hold for the long term. That doesn't change. But the limited point was anecdotal evidence, right, Vijay, where during the 3 years after COVID-19, somebody's seen a 21, 22% rate of return on their equity portfolio, and their aunt or their uncle has gotten 25%, and they're saying, oh, wait, you know what, my distributor has not done a good job, let me just shift, which has happened. I've seen this happen. And so that is what I'm talking about when you're saying expectations. Is your long-term equity expectation 15%? And if it is 15%, and if you've gotten 21%, that's significantly ahead of your expectations. So don't do anything. That is the point.
It could be one reason that it could be ahead of your expectation, or it could be that past return has not been that great. So when you talk about 2020 to 2024, 25, the market gave return because from 2010 to 2020, for a 10-year period, Nifty's return has been 8.5% compounded only, which is the worst decade for Indian equity market in last 45 years. 2010 to 2020 we call lost decade for Indian equity. And the reason was because the corporate profitability has not moved at all.
And then the banking NPAs happened.
2011, the total combined profit of listed entities was just below 4 lakh crore. And 2020, they become 4,55,000 crore. During the same period, India's GDP expanded 3 times. So what happened post-COVID? The 4,50,000 crore has become 16 lakh crore. And that is the reason we are seeing the, very interesting. The return which got from 2020 to 2024 is not ahead of the market, but it was catching up with the past return.
Yes.
And that was the reason that we haven't seen big correction like we have seen in 2008 or 2000 or 1999.
I'm very happy that we've led to this point, Vijay, because it comes to the topic that we've decided to discuss today, which is phases in the market. You saw the lost decade, as you pointed out, in the equity market, and that was a phase. The catch-up, as you called it, was effectively a bull run, which some might argue we've just simply seen a pause in the ongoing bull run and we could be heading higher. All of this, what we're seeing right now, is a symptom of flows and various other aspects and outperformance over the last 4 years. So let's identify what these phases are in equity specifically. How would you define them?
So the current phase is accumulation phase because the past 3-4 years return has been very, very good till September 2024, but they were not as high as 92 or year 2000 or 2008. So we have been continuously communicating that we don't see big return we don't see big correction in the market, because even at the peak of September 24, the Nifty 10-year return has been in line with GDP growth. So nothing out of the world. Only small and mid cap was delivering much better investment performance. So I expected it was not going to big drawdown phase. Big drawdown phase happened when the market has delivered really knockout performance over a 10-year period. So for instance, just look at 1992's 10-year return. 1992's 10-year return on Sensex level was 21 times in a 10-year period. In a 21-year time. 21 times. And if you look at 2008...
21%, you're saying?
21 times, not percentage.
21 times.
The Sensex moved from 282 to 4,300 in a 10-year period.
21 times?
Yes.
Okay.
When people say 90 just a market ho jayega, they don't have the sense of these numbers. Second, look at 2008. If you look at January 2008 market, in 1992, there was no equity mutual fund. In 2008, there was an equity mutual fund. So I looked at the average NAV growth of all diversified equity mutual fund in 2008. The 10-year NAV growth has been 21 times.
From 2008 to 2018, you're saying?
1998
Oh,
to
98,
2008.
okay. Wow, okay.
And now when I looked at this number for 2024 in September, the best was 6.5% or 6.5 times, 7 times
Wow.
in mid and small cap.
Right.
So it was not the market where we are going to see big drawdown. This is a market where we're going to see accumulation. And this is a great time for investor to start accumulating when earnings are not growing, when the commentary is negative, when there are so many doubts about the market. Don't abandon the market at that time.
Is the accumulation phase different from a drawdown phase?
Yeah, because drawdown phase is very sharp and the recovery is also equally sharper, as we have seen in
COVID-19.
2008. 2008, very interesting number. January 2008, 21,000 Sensex, fell to below 8,000, recovered to 15,000 by July. It came back to the same number by Feb 2013 by at the end of 6 years. But interestingly, SIP made money for you in 16, 17 months because in drawdown, when you big drawdown, the number of units to accumulate goes up. So the part to the profitability was very short. Like in
You know, that might seem like a very obvious thing, Vijay, but I think it's important for you to explain that concept. Can you do that with a very simple illustration?
So 21,000 was the Sensex in January 2008. It fell to 8,000 level.
Yes.
So it fell almost 58%. But from 21 to 8, so you almost got like 1/3 value
Sure.
approximately.
Yeah.
So what you're buying for 10,000 rupees SIP, you're buying 100 units for 1,000 unit. Now the number of units has gone up to 2,000, 3,000.
Sure.
So when the Sensex went to 15,000, the 2,000 got valued at 15,000, so basically 30,000 Sensex number. So the best part in SIP, when the equity market goes down through big drawdown, the number of units you accumulate are very high, but all of them would look very good on hindsight. But when you're going through that process, that is the most troublesome.
At the cost of simplifying this to the very, very extreme, it's like buying certain units of a commodity, something that you're consuming. If the market value of that falls by half, then you effectively can buy double at the same price.
This is what we have seen in SIP.
Yeah.
But when it is happening at that time, like when you go to the workout, when you go to the gym, when the trainer makes you train hard, at that time you feel like it is not a good thing to do, just give up. And after you finish your workout, you feel so relieved that you have done that. So it's just identical, that kind of feeling. But that happened in half an hour time or in 10 minutes, 5 minutes or like 1 hour. This journey sometimes takes years, and that is very unnerving for people like us. And if you are alone investor, you're not talking to somebody except your advisor, nothing happens to you. But we are a social animal. And India is a very funny country where everybody is accept in every walk of life except their own walk. So what happens that you go a morning walk, friend tell you, कहाँ पैसा डाल दिया, ये तो डूब जाएगा, SIP में तो पैसा बनता नहीं है. So these kind of thing troubled investors' mind. So there again, what we have witnessed is very, very interesting. A woman investor is better than a male investor. Because
and the data that supports this argument?
Absolutely. My anecdotal experience tells me, when you tell a woman that this money is for your kid's education, this is for his wedding or her wedding, this is for the retirement, she won't allow the husband to touch the money. Else the husband every day gets some brilliant idea, from FD to crypto. So that is
You sound like you're speaking from experience.
This is what we are witnessing with many clients. But the moment you involve a spouse or particularly lady member of the family, they're actually much more sorted in investing. The male want to prove himself every point that I'm smart, I know what is happening around the world. Women are not. Let's assume that the gold jewelry was in the hand of male. What would have happened?
Of course, you would have sold at every point till over a lakh.
To fund this, to do this, to buy whatever,
इससे ऊपर तो जाना नहीं है.
Whatever, the woman held it.
By the way, I'm talking to you right now. If you've got an opinion on this, let us know in the comment section. If you don't agree with what Vijay said.
And I'll give another analogy, which could be a little challenging. So if you see a woman driver driving, many times you feel irritated that driving in the wrong lane, not driving fast enough, whatever. But statistically, the women driver commit less accidents than male driver.
Yeah. Okay. because she's more careful.
She's more careful.
Look, there are exceptions to all of this. I want to say
exactly. Yeah, there are always exceptions.
It's
to
not
everything,
necessarily
including
broad
this
brush.
one. Yeah.
It is not necessarily
it's not a
broad
brush, but this is what we have seen.
But having said that, we were talking about phases, and we've discussed drawdown phase, we've discussed accumulation phase, which is essentially a time frame when the market doesn't do too much for a pretty long period of time, and that can take place at the individual stock level for years together.
Yes.
Right? There's also the bull phase. And how do you read this? Because this is typically a period of exuberance. So either it gets you excited to get into all of the overheated areas, because that's the tendency of retail investors. Usually, if you imagine the stock market as a bus and everybody is piling in, the last one in and the last one in, the last one out is the retail investor, unfortunately. So how do you approach the bull phase?
So I think I don't know about the individual stock or IPO or some
the mutual
part of
fund.
the market, but if you look at the mutual fund, when you talk about top of the market, it is assumed that you are investing only and only at the top of the market. So I did a study of 92 market peak and 2008 market peak. So if you invested in 92's peak, for you to make money, it took you 13 years, 11 and a half year approximately, 11 year plus. Provided you invested only and only at the market top. But suppose you invested 1 year before, you like 12-month SIB before 1992, continued to invest till April 92 till April 93. So you invested 12 months before and 12 months after, you made money in 18 months time. So bull market or bear market, if you are investing regularly, then 90%, 95% of the time, you end up making money over a 7 to 8 year period. So when you look at investing, always keep in mind the market level tops and bottoms are only known in the hindsight. What is in your hand, how much you're allocating to equity, and how long you have the ability to hold it. And third, which is most important, how much drawdown you are willing to tolerate, because in equity journey, the drawdown will happen. And I'll just tell you simple illustration of HDFC Flexi Cap Fund. The fund had a NAV of 10 rupees in 1995. The fund's NAV became 2,000 rupees. But this fund's NAV fall 10% almost every 6 months, 15% every 1 year, 20% almost every 2 years, 30% almost every 3 to 4 years, and 50% almost every 8th year.
50%.
It has fallen 3 times in 30-year period.
Yeah, okay. So 2008 financial crisis, you have the COVID-19, and you have one more. Yeah.
It happened in 2008.
The dot-com bubble.
The dot-com bubble. But if you stayed invested and continue to invest, I'm just taking the name of the fund because I remember the data.
And it has a pretty long history.
And it doesn't mean that other fund who has not done it, but the point we are making is very simple. If you have the holding period as long you have for real estate and gold, equity will create amazing wealth for you. Understand how the asset category deliver return. It is volatile asset category in the short term, but in the long term, equity is the most predictable asset category. Just keep that in mind.
So in the accumulation phase, and it's very difficult to identify the extent of these phases, but broadly, you know that you are in an accumulation phase. Look, you look at the 1 year performance of the benchmark and it'll tell you it's single digit. So it's basically not done anything much, right? And in the interim, Vijay, we've done a couple of these conversations over the course of the last 1 year, and we've seen the broader markets go up by 20%, down by 20%, and recover from that point, right? Or actually down and then up by 20% and not done too much. The point is, how do you react to it? Do you increment your investments in a drawdown phase, for example? It is ideal to reallocate, to say that if you have money lying in fixed income and you have a sizable shift in your asset allocation, that is a time to shift to equity. It's a no-brainer, isn't it? In retrospect, in particular, it's a no-brainer. At that moment, it scares you a lot.
So exactly, we keep saying that the data can be back-tested, emotion cannot be back-tested. Yeah. So at that particular moment, how would you react? It is very counterintuitive for investor to put money where they're already losing the money. It is very easy for me to go and talk about gold and silver right now because it is a product which delivers absolute return in last 1 year.
Sure.
Who was talking about gold and silver 2 years, 3 years back? Nobody was talking about it. But that perhaps was the best phase to accumulate. Gold also had a accumulation phase. So how to identify accumulation phase? Whenever you look at equity return, which are at least 5 to 6% lower than nominal GDP growth over a last 10-year period. It means nominal GDP growth has been 13-14%. Equity return has been 8 to 9% over a 10-year period. Fantastic time to accumulate and accumulate and accumulate and put more money. When 10-year numbers in any asset category become 20% kind of number, that perhaps is not the time to look at allocating new money. And Alex, remember in our program, we talk about a small cap, mid cap, just around 1.5 years back, where everybody was gung-ho about a small mid-cap fund. And we spoke about not to do it. And people are saying, suppose you have long-term vision, can we invest more in a small cap? Long-term vision is fine as well, as long as the returns are positive. The moment return hit negative territory, all the long-term goes out of the window.
So I want to talk about where we stand right now. Because ultimately, and you mentioned gold, which is a perfect opportunity for me to contextualize what I want to get from this conversation, right? Because around the time when gold was underperforming and everybody was like, ignore this asset class, it doesn't yield you anything. It's simply a store of money. It's not beating inflation. Things like that were being said at the time. It was also being said at a time when you had yields that were at a certain level, right? In the US, you had treasuries that were pretty a big opportunity at that point. So people were diverting money into that, and the dollar was incredibly strong. So all of those aspects were happening at that time, and the thesis at that time would have been to go against all of this to say, in the long term, because geopolitics is going a certain way, gold is likely to go a certain way as well, particularly because central banks are buying. All of that seems clear right now. What is the thesis right now that is telling you something about the Indian equity market, and how do you allocate from this point?
I never felt so positive about this country and the economy the way I'm feeling right now. One of the most ignored sector right now perhaps is manufacturing sector, the consumption, the pharmaceutical, where all negatives are there. And we are starting seeing value emerging in IT space as well. So I would say, suppose you have a long-term money which you don't need for next 5 to 7 years, you start allocating over the next 1 to 2 year period. The market will reward you handsomely. And the best time to accumulate when you don't feel like accumulating, because the news flows are negative, commentary is negative, and market is ignoring every positive news. But I think the Indian economy is going to be in good shape, and for that, we need to thank Donald Trump.
Why do you say that?
Because he's waking us up. He's making us realize that we have to stand on our own feet. We can't rely on anybody. And to protect our economies, now there's a legitimacy. Earlier we were worried about WTO, how other people will think. But now the biggest economy in the world is behaving like African economy. Then why not country like India, which import lots of stuff from everywhere? There's a lot of
start becoming more self-reliant.
Yeah, and if you look at all kind of stuff, like where people, like if you look at YouTube, X, Facebook, Meta, all these Googles, all these companies are making money from India without exporting or importing anything. So I think it gives a lot of legitimacy to the government of India to put policy in place where they protect domestic economy, make domestic economy more and more competitive, and there are enough signals we are getting where this phase is happening. So this, in my opinion, save this interview, Alex.
Oh, it's saved. It's going to be uploaded soon.
For 5 years. If anybody start SIP in India and continue the journey and willing to live through volatility, we will meet in November 2030 and look at your portfolio.
Okay. I want to end this conversation as I began it, by setting those expectations, right? And you said that people will make money, which is fantastic. But would you say that, and look, we're speaking at a time when we're nearly done with the Q2 results. For everybody that tracks it, you know that it's actually better than expected. A lot of companies posting better profit. And so therefore, the question to you is, would you still peg your long-term equity growth at very close to the nominal GDP, which is around that 10-11% mark, and you peg it by a couple of percentage points more than that, and say if you're getting between 13 and 14%, you should be happy?
I think this has been the long-term track record, So don't look at Nifty 50 and Sensex 30. These are not indices which genuinely represent what is happening in India's growth story. So look at S&P 500, look at more toward mid and small cap over a period of time. I think their numbers are fascinating. So I'll give one simple number. In last 10 years, The large cap market cap has gone up 4 times. The mid cap has gone up 7.5 times. The small cap has gone up 9 times. And with this correction, I think the more and more interesting opportunities will emerge. So in India, it is not wrong to have 13 to 15% expectation, provided you are willing to live through the volatility. The condition is there will be volatility in the portfolio.
On that note, Vijay, thanks so much for taking the time. Always a pleasure.
Thank you very much.
That brings us to the end of this edition of Moneywise. Thanks so much for tuning in. This is NDTV Profit.